Hey everyone, welcome back to another video. In this video, I'm going to be looking at the recent earnings results for Netflix's third quarter of 2022. And as we can see right here from their stock price over the last year or so, their stock price is down over 50%. But interestingly enough, if we look at their all-time, or not all-time, but 52-week lows right around here, it's right around 166. If we scroll down, we can see that it's right about like $162 per share. And right now they're trading at $300 per share. So that means that right now they're up about 80% from their 52-week lows. So they have made quite the recovery from their 52-week lows. And so in this video, I'm just going to look through the earnings results that came out for Netflix basically last week when the earnings month or earnings week pandemonium kicked off. I'm going to go into their financial statements to look at the financial health of the company. And then I'm going to try to value the company, but we'll see in a minute here why it's pretty difficult to do that using the normal methods that I use in my videos, like valuation models and discounted cash flow models. So if we go into their financial statements right here, these are the results from their third quarter of 2022. This is their income statement right here where they're comparing their third quarter results for 2022 to their third quarter results for 2021. And we can see that their revenues have increased from about $7.4 billion up to $7.9 billion year over year. So that's an increase of about 6%. And during this time period, their net income has actually decreased, even though their revenues have increased. Their net income has fallen from about $1.449 billion to $1.39 billion year over year. And on top of that, their earnings per share has also decreased from about $3.19 per share to $3.10 per share. And so we can see the main reason for that is because of the cost of revenues line item in their income statement. It's increased pretty fast in comparison to their actual revenue incline. And as a result, their operating income was actually lower this year than the third quarter of 2021. And so that's what ended up resulting in the decrease in their bottom line here, their net income. And so if we go to page 5 right here, their cash flow statement, we can see why that might be. And Netflix's business model is pretty unique. They have an interesting problem with cash flow, which is that right here you can see their additions to content assets line item is pretty big. For the 9 months of this year, they've spent about $12.8 billion worth of capital to attain new content for their streaming platform. And of that, about $4.5 billion of that came in the third quarter. And so we can see right here that basically how Netflix acquires these new shows and these new areas of content for their streaming platform is they pay for these new shows and other whatever it is, or documentaries or whatever that they're showing to their customers. They pay for that content with cash up front, and then they amortize those assets over their operating life. And so as a result, they end up resulting in large amounts of cash leaving their business in order for their business's operations to continue. And so that's why their net cash provided by operating activities is usually so low, and why they usually have negative free cash flow, which basically is when you take the operating activities, the cash flow from operating activities minus the purchase of property and equipment. And we can see that in the third quarter of 2021, they actually had negative free cash flow of about $106 million, but that increased to a positive $472 million in the third quarter of 2022. So they did a little bit better of a job managing their cash flow in 2022 than in 2021. But that could also just mean that they were acquiring less assets in this quarter than they were in 2022, which, as we can see, that actually did happen. And so lastly, for their financing activities, we can see that they are raising money by issuing common stock, but they aren't repurchasing common stock anymore like they were last year. So they might not be prioritizing returning value back to shareholders this year as much as they were last year. And so to end off the financial statement analysis, I just want to look at their balance sheet, and we can see that right now they have total assets of about $47 billion, up from about $44 billion. And then we can see that the majority of their business is financed by liabilities as opposed to equity. And their equity account has increased mainly as a result of an increase in retained earnings from about $12.6 billion to $17 billion. So a ton of increase in their equity position as a result of earned capital from their business. which is always a good sign to see in a company. And so right here, I attempted to use a discounted cash flow model to find the intrinsic value per share of Netflix like I usually do. But it didn't really work because as we saw from their financial statements, their free cash flow amounts are pretty low, and they usually are low quarter to quarter. And actually right here, I went on to TradingView, which is a stock screener, and I'll put a link to this in the description. But we can see right here for their cash flow amounts for the last couple of years that their free cash flow has been consistently negative for pretty much all of the last few operating years. And so it's kind of difficult to use a discounted cash flow model, which relies pretty heavily on a free cash flow amount for the first year for the analysis to start, for the model to actually start, if you don't have positive free cash flow. And so for my model, I ended up just using the amount for the trailing 12 months of free cash flow for Netflix. But obviously, if you're taking a low free cash flow amount of about $717 million for a company that has 445 million shares outstanding and a net debt position on their balance sheet of about $10.3 billion with a low growth rate like 5%, you end up with intrinsic value per share estimates that are negative. Because obviously, if you take the year one free cash flow and then you grow that by these growth rates, you get a positive present value of future cash flows amount. But when you subtract out the amount of billions of dollars of debt sitting on their balance sheet relative to the hundreds of millions of dollars of debt that they have in free cash flow per year, you end up getting a negative intrinsic value per share amount using a discounted cash flow model. And so this is one of the limitations of the discounted cash flow model. It doesn't really work that well with companies that have unique operating or unique business operations or unique business models that don't really prioritize free cash flow. But that being said, on the right-hand side here, we could still do a competitor analysis to compare their business efficiency ratios to other companies competing in the streaming industry. And so obviously with Disney, they have their Disney Plus. Amazon, they also have their own streaming services. And then Alphabet, Google, they obviously own YouTube. And so if we compare these companies against each other, we can see that Alphabet is dominating, but it's kind of an unfair comparison, obviously, because all three of these companies, Disney, Amazon, and Alphabet, aren't just streaming companies. Obviously, they have other services and products that they sell that make up larger parts of their business. Disney with their Disney World, Amazon with their website, obviously, and Alphabet with Google and their other ad platforms and their other investments in technology. So comparing Netflix to these other companies doesn't really make that much sense, but these are their main competitors at the moment. And if we compare them against each other, we can see that Netflix's gross profit margin, pretty similar to Disney and Amazon. Alphabet's is definitely ahead in all aspects of the business efficiency ratios. But Netflix has a higher net profit margin than Disney and Amazon. And then they also have a middling ratio for return on assets. So based on this competitor analysis and based on the intrinsic value analysis, it seems like Netflix is kind of difficult to value from an intrinsic value perspective. But that being said, they did obviously announce an increase in revenue, although there wasn't an increase in earnings for the third quarter of 2022 compared to 2021. But their stock price has increased quite a bit by about 80% from their 52-week lows. So it'll be interesting to see where their stock goes from here. Definitely going to be keeping my eye on Netflix. Seems like it could potentially present some interesting opportunities to come in the future. Obviously, if it grew from where it is now to where it was at, its all-time highs, that would be more than a 100% increase. And it is up 80% from its 52-week lows. So interested to see where it'll go from here. I'm not too sure. Let me know in the comment section down below what you guys think about Netflix. Subscribe to the channel, leave a like on this video, and I'll see everyone in the next one.